Hello friends, once again welcome you back to the channel. So as of the previous video, I promised that I'm going to start on a new video series whereby actually this is going to be the main topic, the institutional point of view. So basically in trading, it's not that I'm an institution. I'm not an investment banker, but at least from the information that I've read and at least my experience, my trading experience, back testing, and all that, I'm going to be bringing out some of the reasons behind certain moves that happen in the market. So basically, I request that you stick around, and I'm going to make a playlist so you can go you can check out the playlist. It's going to be called the institution point of view. So that's it. So today we are going. The first topic under this video series is going to be manipulation and distribution. So basically, I'm going to be explaining that, and there are several topics, but yes, they're going to be quite a little bit in order. But to be honest, detailed information, all the reasons and all that, I've been actually I talk about it in mentorship. So I don't want to be making these videos long, but at least I'm going to be introducing certain concepts. But detailed information, I talk about it in my mentorship. So basically, the main topic today is going to be uh, uh, it's going to be manipulation and distribution. So basically, that's what we are going to be looking at. And by manipulation, if I can put it simply, we are going to be considering consolidations, consolidations or ranges, and then distribution. Distribution is going to be these moves that happen. You get. So basically, you're going to find that in the market, we have these two seasons or these two cycles. You get. There's another one, the third one, but we are going to be mainly looking at these ranges, most looking at the sideways ranges, or sometimes the market could be ranging as it comes down like this. It could be ranging, but mostly we are going to be looking at these ranges that go sideways. So that's what we are going to be looking at. Then distribution. By distribution, I'm going to be meaning these moves that happen later on. You get, that happen later on. I believe the information that I'll be sharing will be beneficial. So the first points, actually the main points that I can talk about this manipulation and distribution. So basically, uh, we shall be looking at markets in a different way. We are going to be finding what could be the possible reasons behind these manipulations, because I told you, uh, it's good to trade it's good to trade when you know what you're trading, and you need to be knowing why certain things happen in the market. You get. So basically, given that here we are trading currencies, or whenever we place, actually, now the reason is, when you go into the market way back, if you wanted to exchange, let's say dollars, if you had dollars and then you want euros, you had to look for someone who is willing to give you euros, and then you give them dollars. But these days, you find that these markets that we are in, they are liquid markets, like they are liquidated, whereby each moment you go and then you place an entry, let's say you buy, you're going to find that your order gets executed right away. You get. So what differs, if I told you you were at this point, let's say at this point, and then you were selling. Let me zoom in a little bit. So if I told you were at this point and then you were selling, you thought that maybe the market would be coming down. Overall, we are here to make profit. You get. But then the market, let's say, goes against you, or it moves up. But now you need to, why is that happening? It's because, if at all, overall, those with more money, or if people are putting in more money to buy, let's say you place two lots, and then someone with 10 lots places an order, which means they're going to go against you. That's the main reason as to why sometimes you place an entry and then you get taken out. You get taken out. So we need to be understanding. Now you're going to find that these ranges, we shall be having to study them carefully and well. Why? It's because, if at all, these institutions, by institutions I mean, for sure there are people with more money. You see, uh, if you're to do proper analysis of the market, you're going to find that sometimes why is it that the market reaches certain points and then it buys, and then it reaches certain points and then it sells? Yes, sometimes it takes time to identify those regions or to understand those regions, but then it's possible for you to understand them. But now, why is it so? Given that we are all in the business of making money, or we are here to make money, now we need to think like the institutions because they hold more power. You get? Because for us, when we come with our small accounts, or even if you have a big account, really, if at all the market is trading over 6 trillion US dollars a day, you Google it, you get at least the daily volume is now over 6 trillion US dollars. A few years back, it used to be 4 trillion US dollars. That's why these days, your chances of losing are high or your chances of winning are high. Why? It's because there's a lot of liquidity in the market. You get? So basically, given that we are all in the business of making money, we need to be careful at the points when we are buying. You get? At the points when we are buying. So basically, to my students, they know that whenever we see consolidations, and it's one of the reasons as to why in the previous episode where I was comparing my personal experience about synthetic indices and then forex, is that we take long to get these consolidations in synthetic indices sometimes, or when we get them they really take so long. Why? It's because these consolidations, personally, we study them, or I analyze them. You apply a number of tricks most of the time so that you be part of the move that happens. We want to be part of the distribution. You get? So sometimes it depends on the time frame, but you don't want to be trading during this range when the market is just ranging, going sideways like this. You get? Though we need to, you better be, it's all about you being knowing what is happening. Sometimes if it's a big time frame and then we are ranging, which means you're not going to be holding trades for long. You get because the movements are going to be choppy. The market moves up and then you take profit, it moves down, you take profit. But then when you are in distribution, we can hold trades. You get? So it depends on the cycle where we are. And then, by the way, one of the other main reasons as to why I'm starting this video series is because I've been, to a certain extent, I'm tired of these questions on over on Telegram. Yes, I have a Telegram link, but then there are those of you who want me to do account management. You get? Those of you who want me to do account management, I don't do that. You get? Because to be honest, most of the people are blowing people's accounts, and then take time. Don't just trust people to be trading for you. Only what you need to do is to ask them for knowledge. You get? It's better that way, because you're asking me to do, let's say, to do account management just because you don't know how to do it yourself. You get? So I'm teaching you how to fish yourself for yourself. Then number two are those people who are requesting for signals. You're going to find that there's no specific point. Most of the time there's no specific point that, let's say, the market is going to turn exactly here, because I have friends who are fellow traders. We do trade, but then you're going to find that when we are trading, when we are trading, we just look at a zone. If at all I sell here, he sells at this point, but then we go into profit. You get? And then that's why some of you look at, I'm happy with someone who asked a question about what is the difference between support and resistance and then supply and demand. I was more interested in the side of supply and demand, because when we go into supply and demand, we are not going to look at a specific point. You get? Because I may give a signal to sell here. Yes, I go into profit, but then we had this candle that was bumping up. You get? So sometimes it's really hard. All I want to bring out is that it's good that you get information. So, and then the third point that I would bring out, there are those who want me to first give is it a demo for mentorship. I first teach them for a few days and then they be part. My mentorship is not forced. You get? It is up to you, and and all of you got to know about me through YouTube. So if you like my content in any way, so I believe it's enough sample space for you to choose to go on with me to teach or not. You get? So let me proceed. So uh, mainly, why is this happening? Why do we get these consolidations? We are going to start on a few reasons, and we are going to be also getting reasons as to why we get these distributions. So mainly in the market, given that we're in a business where there are no physical products, but even the institutions that are there, they are there to make money, and then they make money when others are losing money. Basically, that's it. You get? So we want to be identifying, or you really need to analyze and then find out those areas when the market will be willing to to be will be willing to buy or sell. You get the best time frame, the best time. You get, and then you're going to find that we want to be part of this move that is really coming down. But then the challenge is that even these moves that are where the market is distributing, you can see that the number of pullbacks you get, sometimes you may get in here and then the market first gets against you. So you get confused. You get why? It's because these markets, there's what we call uh, money is made through fear and greed. You get? Through fear and greed. Here, during a consolidation, the market will be creating fear because it's ranging. You don't know where it's going. You get? So this is what we call fear. You get? Now, here we can see the market starts to distribute. You get? When it starts to break free and it's going down, you get? They create what we call greed. You get? So here you fear and here you get greedy. How? You see the market moving and then you jump onto it. They come against you. Now, it's most likely here we on gold. Actually, this is gold, the 1 hour time frame. They get against you and then they proceed. You get? So you really need to know what matters most. If at all you properly analyzed here, maybe possibly as we shall see in future, because there are a couple of episodes that are coming, it's best for sure, it's really best for you to be part of, let's say, this move that really happened in this region. You get? This region here, this was the best time for you to get in. So whichever was happening here, now I believe some of my students that were part of the initial mentorship, now they know how to identify these zones. You get? We wouldn't have gone maybe as far as this point, sometimes this could have been take profit point two, but most likely would have been taking our profit here. You get? So for those scalping, sometimes we hold. You get? Sometimes we hold. But now that's what I want. Those are the main things that I want to be bringing out, and I believe the information here will be helpful. But if you find any information helpful, please endeavor to subscribe. You get? And you can leave a comment below. So that's what I wanted to say. So now, given that, what we need to know, when they want us when they want us to be fearing, for us we shall be getting interested, and when they want us to be greedy, we shall be taking our profit. We get? We shall be taking our profit. So basically, the next thing that I want to maybe that I can say, given that this is the introduction to this video series, is by the have you ever imagined about how these candles form? You get? You're going to find that most candles, let me first analyze for you a bearish move. You get? It starts like this most of the time, then like this. So they create fear, they distribute, and then they end into fear. So the market maker hides in a consolidation. You get? That's where they hide because they know you cannot go there. You get? They start in a consolidation because given that the next candle is also starting in a consolidation, you get? It's starting in a consolidation. It may proceed like that. You get? And then we come down. You get? We come down and then we end like that. Or sometimes this consolidation will be like this. You get? So this is just an illustration, but it's what happens. These are the emotions that get into us. You get? These are the emotions that we get as we are trading. Actually, normally it may be like this. You get? You get? So how this is a bearish market structure, but then I'm just illustrating the emotions before we take entries. We get into fear. There is fear, a consolidation. They distribute. You get greedy. They come. You get, and then they consolidate. You get, and then they move, and then they come and distribute again. So you really don't know where to get in. You keep on being in a drawdown. Most of the time, you find yourself, if at all you missed out on this distribution, here you get in, the market consolidates for a long period of time. you're not getting into profit, and then it distributes down. You get, for you were buying at this moment because you think that the market had started to move up. So uh, these are the emotions that are in the market. What matters most is for you to analyze beforehand where we are going. You get, and then sometimes, why is this consolidation happening? Much as this is what we call gathering liquidity. So which means a person, I get happy, and this is the main point. This was the main point as to why I was against these synthetic indices, the synthetic indices, because I told you sometimes they can distribute for so long, and it may be hard for them sometimes, and then sometimes they can manipulate for so long, or they can consolidate for a long period of time. You get, so those are the differences. But then we need to be happy when they are creating fear, because for us, we calm down and analyze, and then we buy part of the distribution. You get, so this is gold. It's going to represent uh, the forex. But then you can see that these things happen even on this is M15. This is M15. They happen on all time frames. You're going to find that during certain times of the market consolidates, but then you can see that it starts to break free. You get, it starts to break free. You get, but then in the upcoming episodes, and I request you that you subscribe. I want us to, we shall be analyze we shall be building onto this. You get, I'm going to be building onto this content. You can see it consolidates here, but then you can see later on the market picks up momentum. You get, so that's what I want to bring out. Then we can also check out on synthetic indices. This is volatility 25 index, the daily time frame. You can see that this is what we call, the market here was consolidating. You get, it was consolidating the whole of this area, the whole of this region. Now, you see, this is the point that I wanted to bring out. You get, here, for sure, it really consolidated for so long. This was a long period of time. This was a long period of time. So, but then, that's why sometimes. That's why these days I'm following a couple of synthetic indices, just because sometimes they may keep you waiting because you need. Right now I'm following about seven synthetic indices. You get, about seven. Why? If at all, for instance, for this one, now I started to trade it. You get, I started to trade it after we broke out of this consolidation, but it had taken long. You get, because here it was really risky. It was really risky, though we had gotten a supply area. This was the target. This was the target in this region over here. You get, so sometimes you could get in on buying entries. For selling entries, they were enticing people to join on as they gather liquidity. You get, so basically, and the reason for that is that a lot of money is generated through here, and then we distribute. Actually, that's why for synthetic indices, you're going to find that they consolidate for so long, that, and then they distribute for so long. You get, after these consolidations, you get that when the market breaks free, like, it can move freely. You get, it can move, let's say, for a month when it's just moving, but it can also consolidate for a month. You get, it can also consolidate for a month. Then the last point that I wanted to bring out is that these things happen on all time frames. You get, they happen on all time frames. This is step index, the M15 time frame. You get, these points. You see, there are these points when the market is consolidating, and then it starts to break free. You get, it starts to break free, but you'll find that the best moments for us to get in were when the market was consolidating after us analyzing. So the main thing is that I've explained, I've introduced. Now, in the next episode, I'm going to be talking about imbalance. It's not the first time I've talked about imbalance, but I'm going to be talking about imbalance in this context. You get, in this context, about what I've brought out. You get, manipulation, and then distribution. You get, and distribution. So you feel free to comment, to leave a comment. You can text me on Telegram, but basically that's it. For more information about the same, actually detailed information about these things that I'm going to be talking about, for sure, I've been giving them out in mentorship, and I'm still mentoring students. You get, I'm still mentoring students. I cannot give out everything. For sure, these people have paid money. They paid money. I cannot just give out things for free. But I thank you for watching, and I wish you the best in trading. Peace.